David R. Guttery is the Chief Executive Officer of Keystone Financial Group in Trussville, Alabama. David Guttery and Seth Edgil are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone. Today I'm joined by Seth Edgil of Keystone Financial Group for a timely conversation as we move into the final months of the year. With fall in full swing and the new year not far off, it is a great opportunity to talk about something that often gets pushed to the back burner, your finances. Seth, thanks so much for being here with us today. So why now is a good time for people to take stock of their finances?
Thanks for having me. I always enjoy these conversations, especially when they involve practical steps people can take to feel more in control of their financial future. As we approach the end of the year, many people are naturally doing some reflection. That might mean thinking about holiday plans, family gatherings, or setting goals for the next year. It's also a really valuable time to look at your financial picture and make sure everything still lines up with your priorities. Even if you already have a solid plan in place, a quick review can reveal areas where small adjustments might make a big impact. A year-end financial checkup helps you finish the year strong and enter the new year with clarity and confidence.
Well, that makes a lot of sense. So what areas should people be focusing on during this year-end review?
There are four main pillars I usually recommend focusing on this time of year. First, your budget and spending habits. Has your income changed since last year? Have your expenses crept up because of inflation or lifestyle changes? This is a great moment to look at where your money is going and decide if it still aligns with your goals. You might also review subscriptions or services that have piled up throughout the year and ask yourself which ones truly add value. Second, your emergency savings. A cash reserve covering 3 to 6 months of living expenses is the foundation of financial stability. But what counted as 3 months of expenses last year may not stretch as far today. If your bills have increased, your savings target should rise accordingly. Automating a small contribution each month can help you build that cushion without having to think about it. Third, look at debt management. Are you making progress toward paying it down? If you've been carrying high interest credit cards, consider consolidation or refinancing. And if you received a raise this year, putting even part of that increase towards debt reduction can help you make major strides. Finally, review your retirement contributions. If you participate in a 401k, 403b, or IRA, now is the perfect time to make sure you're on track to contribute as much as you can before December 31st. Even a small increase in your contribution rate can create meaningful long-term benefits.
Well, that's a great checklist, Seth. Let's talk more about retirement contributions. For someone who is looking to lower their tax burden, how can year-end moves help?
Retirement contributions are one of the most effective ways to reduce taxable income while saving for the future. For 2025, the 401k and 403b effective deferral limit is $23,500, and those aged 50 or older can contribute an additional $7,500 as a catch-up contribution. The traditional IRA limit for 2025 is $7,000, with a $1,000 catch-up for those over 50. Depending on your income and filing status, those IRA contributions may also be tax deductible. Another great tool is the Health Savings Account, HSA. If you're eligible, you can contribute up to $4,300 for self-only coverage or $8,550 for family coverage, with a $1,000 catch-up if you're age 55 or older. Health savings accounts are unique because they offer a triple tax advantage. Contributions reduce your taxable income, the growth is tax deferred, and withdrawals for qualified medical expenses are tax-free. And of course, do not overlook your employer match. If your company offers one, make sure you're contributing enough to receive the full match. That's essentially free money that can compound for decades. Now, I should mention that everyone's tax situation is different. What works for one person may not be the best move for another. These are general principles, not personal tax advice, and it's always smart to talk with a qualified tax professional before making year-end contribution decisions.
Well, that's helpful. You mentioned life changes earlier. How do those impact year-end planning?
Life events are one of the biggest reasons to revisit your financial plan. If you got married, divorced, had a child, bought a home, or changed jobs this year, there are several likely updates to make. One of the most important is reviewing your insurance coverage, life insurance, disability insurance, and potentially long-term care coverage. As your responsibilities evolve, so should your protection. It's a good time to check beneficiary designations. Retirement accounts and life insurance policies pass directly to the named beneficiaries, regardless of what's written in your will. If you've had a major life change, confirm that your beneficiaries still reflect your intentions. And if you received a year-end bonus or another windfall, plan for it intentionally. I often suggest splitting it into categories, maybe some for immediate enjoyment, like a family trip, and the rest towards longer-term goals such as strengthening your emergency fund, paying down debt, or boosting investments. Without a plan, those dollars can disappear quickly.
Well, let's talk about taxes for a moment. What should people be thinking about from a tax planning perspective before December 31st?
Several strategies can make a real difference before year end. Charitable contributions are a great starting point. If you plan to itemize deductions, giving to qualified charities can reduce your taxable income, and it doesn't have to be cash. Donating appreciated stock can help you avoid capital gains tax while still claiming the full deduction for the gift's value. Another option is tax loss harvesting. If you have investments in a taxable brokerage account that have lost value this year, you may be able to sell those positions to realize a loss that can offset gains elsewhere in your portfolio. Just remember the wash sale rule. You can't repurchase the same or substantially identical investment within 30 days, or the loss won't count for tax purposes. For those with flexible spending accounts, remember that many are use it or lose it. Check your balance and spend remaining funds on eligible expenses such as prescriptions, vision care, or over-the-counter supplies. Some employers offer a grace period or small rollover, but it's best to confirm the details of your specific plan. Lastly, review your tax withholding. If you've changed jobs, earned additional income, or had other major shifts this year, your W-4 might need adjusting. Making that tweak now can help prevent surprises at tax time. And again, these are general ideas meant for educational purposes. Tax laws are complex and change regularly, so I encourage people to discuss these strategies with their CPA or qualified tax advisor to make sure they fit their specific situation.
Well, that's a lot of ground to cover. How about investments in general? Should people be doing anything differently at year end?
The end of the year is an excellent time for a portfolio review. Market movements over the past 12 months can shift your original mix of assets. For instance, if your portfolio started the year at 60% equities and 40% fixed income, and stocks have performed well, you might now be closer to 75% equities. That higher equity exposure means you're taking on more risk than intended. Rebalancing brings your portfolio back in line with your goals and comfort level. It's also worth reassessing your risk tolerance. If volatility this year made you nervous, it may be time to dial back slightly. On the other hand, if your goals are farther out, you may have more flexibility to remain growth-oriented. Finally, take a look at your investment costs. Review expense ratios, advisory fees, and trading costs to ensure you're getting value commensurate with what you're paying. Managing cost is one of the most reliable ways to improve long-term outcomes without changing your risk profile.
Well, let's end with this. What advice would you give to someone who feels overwhelmed by all of this and isn't really sure where to start?
First, know that you're not alone. Personal finance can feel complicated and life is busy. The good news is you don't have to do everything at once. Pick one area to start, maybe reviewing your retirement plan contributions or checking your insurance coverage, and take that first step. Momentum builds quickly once you start. If you're unsure how to begin, working with a financial planner can make a world of difference. A good advisor doesn't just talk about markets or products. They help you connect your financial decisions to your life goals and provide structure, accountability, and a clear path forward. The end of the year isn't just about closing the books. It's about setting a tone for the future. A little intentional planning now can make a big difference in how confident you feel heading into 2026.
Well, that's great advice, Seth. Thank you for walking us through this year-end financial checkup. I'm sure a lot of our viewers will benefit from taking these steps before the calendar year flips to 2026.
My pleasure. Thank you for having me.
Thanks again, Seth. And for additional information, Seth may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brannon Dawkins.
David Guttery and Seth Edgil independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.